Good evening and welcome to another edition of You and Your Money. I'm Bryan, and this evening we're focusing again on the investment world. It is not surprising what some good news can do to move our markets. The election results were viewed very favourably, both locally and internationally, with the results that markets picked up last week with some shares rising more than 10%. It's amazing what sentiment can do, and I particularly picked out one share, namely Discovery, that was up nearly 20% from its low when NHI was first announced. Is this because there's a belief that with the government of national unity, NHI might be put back on the back burner? And joining this evening in the Zoom room from Cape Town is my regular guest, Henry Biddlecombe, investment analyst at Anchor Capital. And I'm thrilled to welcome back a dear token after a 6-year absence from our program. He's Senior Discretionary Fund Management Specialist at Investment Solutions by Alexander Forbes. Henry and Nadia, good to have you back.
Good to be back, Bryan.
Yeah.
Good to see you.
I'm trying to work out, are you looking younger or older? But anyway,
Definitely older.
Oh, you think you're looking older. Henry, first question to you. The last time we did our program 5-6 weeks ago, you were quite concerned about markets. You felt actually markets had run ahead with themselves. How do you feel 6 weeks later?
Bryan, I think, yes, you need to distinguish between global markets and the local market. I think they're in fundamentally different places. But looking over the sea to the American market, it's expensive. You know, it's trading on a forward P of around 22.5, 23 times earnings. I mean, it reached a record high in 99 at around 24.5, to give some context there. So there's very little room for error in the American market. Market breadth is very narrow. In other words, the total return of the market's been carried up by a handful of mega cap tech shares. And to the extent that there are any materially negative surprises, either on the macroeconomic front or at an earnings level, you know, the market can fall quite quickly. So I'm concerned about the American market, but locally I think there's more opportunity.
Nadia, let's understand, I started my opening remarks, and I've always been a firm believer markets being driven by sentiment and fundamentals. Yeah. And if they both positive, markets will move up, and if they're both negative, markets will move down. But when they're out of sync, then markets are all over the place. I picked out Discovery, not because I want to use Discovery as a stock, because Discovery had a big fall when NHI was first announced. And then last week, with the government of national unity coming into force, they jumped up 20%.
Yeah, so it's been interesting times on the local market, Bryan. You know, that it's been very sanguine for a period of 7 years. You know, obviously the economy has been very disappointing. You know, structurally we've battled to get growth going. It's kind of been one crisis after the next. You know, we had sort of the crisis of confidence. You know, prior to President Ramaphosa being elected, and then we had the electricity crisis, and now we had the port and rail crisis. And then we had the volatility leading up into the expectations for elections. So to your point, there had been a lot of things that have impacted sentiment, and that really battled to get markets going. You know, I think that I'd have to agree with Henry, you know, that it sort of seems on the local front that the stars are starting to align a little bit. And, you know, market participants certainly getting very excited about, you know, the election results, how maturely we handle the election results. I think we can't take that for granted, Bryan. I mean, you know, there's a lot of places in the world where, you know, parties and presidents lose power and they immediately cry foul. You know, the ANC accepted the election results for what they are. They've said this is the will of the people, and they've given us a mandate to work across the political spectrum to find a solution to take South Africa forward. And that's certainly, the market has taken a lot of cheer from, you know, that mentality. You know, we've seen our bond yields have come down quite a bit. The rand is strengthened below 18 rand to the dollar. You know, the local equity market has bounced quite hard. Obviously, there's still a lot of details that need to be ironed out. We see that in the days subsequent to the signing of the GNU Statement of Intent. There's a lot to be ironed out. There's a lot of things that need to be put in place. At the end of the day, there needs to be policy delivery now, but the market's starting to hope that we're going to be able to get sentiment in the right place. We're going to be able to get some sort of ongoing implementation of structural reform. And if that happens, and we've been a number of days now, in fact, a number of months now without any electricity shortages in South Africa. And if we manage to get the port situation sorted out and we manage to bootstrap growth, our local market is trading on very low multiples, relative to its history, relative to developed markets and the rest of the world. So certainly, starting to see a lot more of if that favorable backdrop does materialize from the election outcome, that certainly can be a catalyst for our local market to continue to re-rate quite aggressively.
So you being very much involved in fund management, how are you positioned? I mean, you talk about if this happens, if that happens, but all the different things. You've got money coming in, you've still got to make calls.
Correct.
What sort of calls are you making?
Yeah, so look, Bryan, I mean, our latest base case kind of view on asset allocation is that, risk assets or equities in South Africa are quite cheap. The valuations are quite favorable. The earnings outlook in select pockets are starting to improve drastically from where they were a quarter ago, 6 months ago, a year ago. That view will continue to gain momentum, obviously, if we start to see an ongoing implementation of structural reform. So on the back of that, Bryan, we're actually quite constructive on equity assets in South Africa. Having said that, there are pockets of concern in the global market with regards to valuation. Henry picked up on some of those, particularly within the US. But the global economy continues to seem to be chugging along. A lot of the concerns about a hard landing and the global economy going into a recession seems to have abated for now. We're obviously seeing a lot of earnings delivery from a lot of these companies that are very expensive, but they continue to produce the goods in terms of earnings delivery, particularly within the US large cap tech sector. And on the back of that, overall resulting in an environment where we're quite constructive on risk assets globally. Possibly the US one concern that stands out is valuation, but overall quite constructive on risk assets. And if should the market broaden out and should that those earnings numbers come through in the rest of the sectors globally, because the global economy doesn't go into a recession, we believe that certainly does present an opportunity for equities across the world, actually.
Henry, you talk about 22, 23 times earnings, but if you strip what you call, and maybe it's not the Magnificent 7 anymore, maybe the Magnificent 10, but if you strip those out, doesn't the earnings look a lot better?
Yeah, so I mean, the rest of the markets obviously trailed the big stocks, big tech stocks. So, on a valuation level, the rest of the market's looking a little bit more reasonable, but certainly still not cheap. So I guess at a portfolio level, if you're able to strip those out, or if you're able to hedge those out, then I think already you're addressing some of the bigger risk factors at a market level. But you can't defy gravity. I still don't think that there's much scope for the Fed to become incrementally more hawkish from here without equities suffering. And I do think that may happen. There's a reasonable risk of that playing out. The market kind of rallied over the last couple of weeks because for the first time in a long time, your kind of month-on-month supercore inflation in the US came in a little cooler than expected. Yeah. But that's certainly no guarantee that that'll be the case next month and in the month after that. And in addition to that, we can't ignore the absolute levels of interest rates in the US either. The fact is that over the last kind of 18 months, interest rates have gone from 0 to 5%. That is a significantly more hawkish development, and relative to previous hiking cycles. I mean, it's never happened so quickly before, and the impact of that on the economy must and will be real. How long that takes to manifest, we don't know, but I think it'll take at least 12 to 18 months to start having an impact. So it's still early days. I think to be bullish from here is perhaps to be a little bit overconfident.
You know, it reminds me of a story. I worked for Liberty Life in the 60s, and I was part of I was fortunate to back and skivvy for Donnie Gordon. And I'll never forget Donnie Gordon coming up and calling all his executives together. I was in the back room, in the back there, in the background, but I'll never forget what happened. He went down to get a newspaper, and the newspaper vendor told him to buy a share, and he came back and he spoke to Jan Swart and Mr. Rennie. I can't remember what his first name was. I think John Rennie. He said, guys, we're getting out of this market. This was 1970, before an enormous crash. People don't realize how big that crash was. I mean, shares like De Beers and Anglos and Liberty Life came down something like 70 to 80%. That really was a crash. Shares were trading at multiples of 120, 130. And it reminds me of what happened last week. I got a phone call from a grandmother whose son is a lecturer at university, and he phoned his grandmother and he said, look, we got to buy Nvidia. And it's like Nvidia and Bitcoin. Those are the two focus at the moment. You've got to be in Nvidia and you've got to be in Bitcoin. So when you talk about being conservative, if any of the companies in the markets in America disappoint, that's when the markets will get hammered. But Henry, you mentioned interest rates, so let's just get back to that interest rates for a moment. There was comment from the Federal Reserve that maybe interest rates will reduce by one notch this year, a few more next year. When interest rates start coming down, and you mentioned 0 to 5%, will that not benefit ultimately the market?
Yeah, short term. I mean, the short term markets are determined by kind of shorter term sentiment. So, if the Fed are talking about one cut and two cuts end up coming through, that would be incrementally bullish for equities, and they might rally a little bit from where they are now. But the more important question to ask is, what is the impact of a kind of a federal funds rate of 4.5% or 5% on the economy over the next 3 years? 2 years ago, money was free. Now it's reasonably expensive. Where does that leave growth in the US in 2 or 3 years from now? And that's the more important question to be asking. And going back to valuation, there's really no room for error. So if 2 years out, growth starts to slow because money is more expensive, is that priced into equity markets at the moment? Absolutely not. You could make a case for the equity market needing to be 15 or 20% lower than it is today. And that's kind of why I'm concerned. I think that the markets become a little bit complacent, as it tends to in these types of scenarios. And when the going's good, that's perhaps time to bank some profits.
Nadia, let's just talk about bonds.
Yeah.
Because the bonds weakened enormously, and in the last 2-3 weeks, there's been enormous strength in our bonds.
Yeah, that's right, Brian. I mean, it's sort of, if you're a bond investor, it's been at long last. I mean, our bond yields have been at very elevated levels for a long period of time. Our credit default spread, which is basically a measure of, the risk that your government will default on their debt, has been going up consistently over probably a 7 or an 8 year period now, possibly going back even longer than that.
Yeah, I'm going to stop you there because we want to take a break, and I want to make sure that our viewers are going to come back because I think it's very interesting what's happening in the bond market. Sure. So stay tuned. We'll be back shortly.